Good day, Dan Davis, ADK Wealth Advisory Group, Financial Planning World Community. Welcome. Wanted to wrap up the first half of 2025. You could simply say that in my 37 years doing this certainly doesn't even come close to one of the worst years, but it comes in at the weirdest year. I mean, the geopolitical wars, tariffs, all that stuff has created so much uncertainty and just crazy that you really can't make a lot of sense of day-to-day, week-to-week stuff. But I do want you to capture the thought that we've talked about before in the fourth turning, where we talked about that there's a long cycle, secular period, and that has those four sub-cycles, and the last one is crisis. We're in that. And candidly, it goes on for an extended period of time. 2028 to 2035 is probably a window that it ends, and I lean towards the latter part, which I've already explained before. If I really take a look at the underlying stuff of what's happening that I would want to communicate to you, first and foremost, it's the economy. Globally, the economy probably will do 2.8 to 3% GDP this year. You certainly would not think globally that the economy is doing that well if you read headlines. When I read headlines, if I just scan headlines, I read one left-leaning and one right-leaning paper, New York Times and Wall Street Journal. I do that on purpose. But honestly, when I'm done scanning, it always leaves me unsettled because the phraseology of things is so negative. And I just think that's just the way that media really is. It's an unfortunate reality, and it's not something new. You can go back to the invention of the printing press, and the propaganda way of using media has been there since then. So I don't expect more, but I do think that this is a time where you can say, okay, well, what's Dan and LPL's research team think in terms of the economy? And we've talked about the cycle, that every cycle finishes with a recession, and then you start recovery, and then you have mid, late, end. And end is where that recession occurs. We're somewhere in that latter part of mid or early part of late. So clearly, in my view, when I look at the data, we have several years, 2, maybe 4, before we would really see a recession. The data supports that. And there's nothing that I've seen that would cause me to think differently than that. There have been headlines that cause me to read, like the New York Times had an article, IMF predicts economic slowdown. And the way that the first third of the article was just like, oh my gosh, I missed something. By the time I get to the bottom of the article, it says they expected at the beginning of the year that the GDP would be 3.3 for the globe. Now they expect it to be 2.8. I mean, yeah, losing 0.5% is a big deal, but that's still 2.8% growth. So long and short of it is, I think inflation is going to continue to cause the economy growth-wise to be not in lockstep with what the Fed would like to be able to do with inflation numbers, meaning their target's like a 2% level. I don't think we're going to see 2% extended for a while. And the biggest reason is offshoring, reshoring, all that kind of stuff. The more you move away from the one-stop shop China into any other area, the cost goes up. There's also things that, when you're trying to ship product around throughout the globe, that there's costs associated with geopolitical risk, where you've got different terrorist groups, interfering in pirateering ways. So that's not going to go away. It might stop for a little bit and all that. So inflation's going to be around. It's not like we're going to see hyperinflation in the intermediate term period that we're talking about. The Fed's going to have to be in a position where they stay independent and not allow Trump to force them to do things. I think they're doing a great job of that. It is LPL's opinion that there's a high likelihood that you'll see 2, maybe 3 quarter-point drops in the second half of the year. Obviously, we've seen 0 in the first half, which didn't surprise us at all. So when I then shift all that from sort of macro to micro, the stock market surprisingly is doing exactly what we said at the beginning of the year. We thought it'd be super choppy. It's been choppy. Our outlook is still 7 to 11% is the end of year rate of return. Hard to say where that is, but it's my belief that Trump knows that the midterm elections next year are critical, that he doesn't lose Congress. And in order to do that, he's going to need to have more stability next year than he's had this year. So I think there's a really good chance a lot of the tariffs get wrapped up in the next couple months, certainly by year end. And as you heard from in our last video, the UK's 90-day moratorium is in July and August for China. Whether or not they come up with some big, great deal, it's hard to say, but I don't think that the problems are going to extend in the next calendar year. Those coming to closure will be a good tailwind for the markets. The bond market's doing what we thought it would do, but I would say we did think it was going to be choppy, but it's been choppier than I thought. We thought the bond market would do somewhere between 4 and 7. I think it's probably more like 5 or 6 is what we expect at this stage. So all in all, returns we expect to be favorable, but really choppy, and that's what's been happening. My biggest concern, candidly, is around crypto. I don't have a problem with crypto as an unregulated investment. I would prefer it stay that way personally and be a speculative asset. What's happening now is this integration with it into regulation, the regular mainstream finances, and that will be extraordinarily problematic, not in the short term, but somewhere in the intermediate to long run period. If you allow something that speculative to get mainstream and linked up with companies, especially if it's banks and stuff like that, it will create problems. So that's my biggest concern right now. One of the things that's a little bit, not a head scratcher, but interesting, is the dollar's had one of the worst starts of the year, meaning it's been declining value-wise. It doesn't surprise me fundamentally when you see what's happening that that's occurring, but nonetheless, that the net effect of that is unhedged international investments are doing very well, more because the dollar than because of what's happening with international. And I wouldn't try to guess the direction of the dollar. I would try to guess the direction of the stock market before that, and we all know how difficult that is. We've not made any kind of major international plays because we do believe that the U.S. economy and the Mag 7 core AI type stuff is going to continue to drive stuff, and candidly, that just doesn't exist internationally. So in a nutshell, outlook is no different than when we started the year. Things are playing out what we expected. Volatility, expect stock market to have really good returns, 7 to 11, bond market to be more like that 4 to 7, and no real major changes. There's things we're looking at around gold because of our belief around inflation for a while. More to come on that. I'll wrap it up and say thank you very much. I hope your 4th of July week is wonderful and the weekend's even better. Thank you for your trust and your time. Signing off from the Franklin office, Dan Davis.